Everyone, how are you now? It is a beautiful sunny Wednesday afternoon. The market's up after the CPI numbers that came out overnight. I'm not here to talk about that. Softer data was seen as bullish, but there's a huge reversal that happened in equity markets, so they still ended up, but just not as much as they were. I think that's a bit of a win for bears there. Definitely not a win for bulls. I'm urging caution in this market and thinking that definitely keep on trading that VIX strategy of only buying when the volatility goes high. And I think that also technically we're seeing that the S&P 500 has come off a resistance level. However, that's not what I'm here to talk about. So I'm still keeping a really close eye on China and what's going on over there. Also, congratulations. Well done. We got to another day, halfway through the week. So it's wine time. It's after the market. I'm going to enjoy one. Excellent. That's nice. Pinot Grigio. Really nice. Pinot Grigio? Pinot Grigio. Anyway, that's all cool. So we're all eyes on China at the moment with the reopening. So that's been a big part of the trade. Chinese equity markets have absolutely stormed higher. Everyone's going great. Everything's going great with the Chinese reopening. There were protests, then they reopened. Now what we're looking at is the potential. Okay, first off, the Chinese reopening is inflationary. Do not get that wrong. There was a time when China, being China, was disinflationary. They'd bring in cheaper products. You couldn't get the price of anything up. Everything was that's now not a problem. The problem is now that it's inflationary. So all the hard work the central banks have been doing for the last year of the aggressive rate rises, most aggressive in about 40 years, actually, since probably about history, depending on how you want to class it. But the aggressive rate rises to get inflation down, which sort of seems to start maybe be working, is probably going to get undone by China's reopening. Now, here's a bit of a situation that's going on. Because China reopening has been so good for equities markets, what has happened is that there's been huge flow of money that's gone out of the bond market in China from Chinese investors into equities markets. Now that's caused this huge run on bonds. So right now bonds are being absolutely thumped. Withdrawals have actually been suspended from some wealth management firms over in China. There's a real situation that's going on. And that's been going on for a while, so it's nothing new. However, what I'm looking at now is going, okay, so if this huge weight of money is going into the equities markets on a reopening, if there's any slowdown in that reopening, then potentially we've got to have a look at what happens on the flip side of that. So bonds, there's a rule that's in investing that says that if nothing has fundamentally changed with a stock or a bond or any product at all, nothing has fundamentally changed with it except for the price, and the price is lower, then you should probably buy it because if there's nothing that's changed about it, if you know all the information you need to know on that particular thing, but the price just happens to be down, probably because someone has been forced to be selling it. So nothing has fundamentally changed with the stock that you're holding. Someone is forced to be selling it. Someone wants to get out of it. It's changed the price. It's usually a pretty good buy. Or someone knows something that you don't. More likely than not, it's the second one. However, if it's the first one, it's the first one. What's happening in the bond market is definitely the first one. There's just forced sellers that people are just trying to get out of that bond market. And now also because it's one thing begets the next, it's a self-fulfilling prophecy. Because everyone's getting out, everyone then needs to get out. We've seen this happen many times in the past. Happened this year in the bond market as well. People just getting out, not because fundamentally they need to make a move, but now people are just getting out because everyone else is getting out and they think that it's going to go lower. So this is the situation in this one that's coming in. It means that Chinese bonds might actually look like some real amazing value coming up as soon as they can. So what I'm doing is tracking the reopening in China. Now, the numbers that you get out of China are not going to be accurate at all. That Chinese numbers have always been a bit dubious at best. So just pay attention to that. What I'm looking at now, and I'm going to switch over to my webpage, is the Chinese modelling. Pay attention to these guys that have been doing the research. I'm paying really close attention to them. This Wigram Capital Advisors guys, I'm checking out anything that they've got to say about anything. It's fantastic. Their hospitalizations. Now this is the swift reopening chart. Really easy sort of graphic to look at here. That, as you can see, is the reopening. If it's a soft reopening, these are the hospitalizations that you're going to see. With a quick, swift reopening, 70,000 hospitalizations in March. Already Chinese hospitals are running out of ibuprofen, Panadol, or Panadine, whatever it is that's there, that people need to be able to suppress pain from COVID. They're under-vaccinated. The vaccination is not as good as ours, regardless of how you want to argue with regards to the vaccinations. So the numbers that are going to come out are going to absolutely swamp people. You've got Chinese Lunar New Year coming up on the 22nd of January, the biggest human migration of people, the biggest annual migration of humans in the world is Chinese New Year. It's what caused the beginning spark in 2020. It is what causes the next spark in 2023. that you're going to have about 1 million people will die in China if the reopening continues to do what it needs to do. I don't think that it will. Now, I was very early in predicting that the reopening was going to happen. I might be early in predicting that the reopening is going to be rolled back somewhat. I think it's going to be an interesting case of we've got a lot of deaths. We actually need to start bringing this back. And then you're going to see the money flow out of equities markets. Where's it going to go? It's going to go back into the bond market. So Chinese bonds are actually now looking like a bit of a deal. So this is something that I'm just setting up now. So immediately what I did, let's just go and check it out. Do a simple Google search. Let's have a look at some Chinese bond markets. We trade into Hong Kong really easily. The question is if you want to be long Hong Kong dollars or if you want to be long renminbi or if you want to be long USD. These are the products that you would look at for these ones. 2829 in Hong Kong. Let's not look at the, I'm not dealing into China, but 9829 is the US dollar ETF for iShares. This is BlackRock, biggest ETF manager in the world. iShares, so there's no problem with who you're investing with. It's nothing dodgy or dubious. It's in here. 2829 is in Hong Kong dollars. Let's have a look at that. I'm going to pull up Trading View. I've got my IB screen. It's sharp because it's the end of the day and I don't want to open it up and look at it for another while. But you can see that it's down here at these levels. You know, looking at this level here, there's 55.8, coming back up to 57. There's to get back to a level of normalcy. You're going to see some real interesting moves in that. So, look, I think that it's potential that when the money does flow back into it, you're going to get this back up into the 60s level. Pay attention to what happens when that happens there as well. Let's have a look and see if there's any difference with the currency that's going on. 9829 is the name of the other one. 9829. I got that right. Let's have a look and see what this one's all about. It's probably going to show us something. Oh, it's only just been around for a few seconds. It's not even a real thing. So this is the one that's been, this one's off market. So don't worry about that. Look, that's the bit of a play that I'm looking at now. Those are the facts on China. As it stands, I think that maybe going deep into equity markets is not something that you want to be doing until the volatility goes higher again, as I mentioned this. But there are things that you can trade on the sides that can still make you money. I think that this Chinese bond market trade might be one to look at. Don't want to be long Chinese equities either because I think that the reopening is going to be hindered somewhat, and B, because I think that the possibility of you waking up in some of your Chinese holdings have been nationalized by the Communist Party is also a pretty substantial holding. Big sovereignty risk going into China at the moment. So pay attention to that. I hope that helped you out with some of the bits and pieces that I'm looking at now. Hesitant equities, but I've got to find other things to do. This is something else to do. So have a look at that. Trade it under your own risk. All general advice, as always. Have yourself a good one. Get yourself a wine and have a great afternoon. Talk to you later. Bye.